In one country right now, the price of a single US dollar has been quoted near 450,000 units of local currency. That number isn't a typo, and it isn't a rounding error. It's what a loss of confidence looks like when it finally stops pretending to be gradual. And the uncomfortable part is that this kind of move rarely stays local in the way people assume. Because the same three signals that flash before a currency breaks in one place tend to light up elsewhere long before the word collapse shows up. What makes this moment different is the speed that modern markets can compress time, not months, not weeks. That's how currency events behave when liquidity thins and trust becomes a tradable asset. Officials say stability is their priority. Commentators say the system is resilient. And then the chart draws a line that looks like a cliff, and everyone pretends they didn't see the slope that led to it. They said this could never happen in developed markets. They said reserve currencies don't crack because the plumbing is too deep and the demand is too permanent. They said the world has no alternative. Yet the data, quietly and consistently, has been telling a story that doesn't match the confident speeches. The story isn't a single doomsday headline. It's a set of pressures building in plain sight. Here's the part most people miss. Institutions do not wait for the headline. They move when incentives change, when collateral is questioned, when settlement becomes less frictionless, when the cost of hedging jumps, and when policy inconsistency becomes a measurable risk. By the time the public hears concerns, the largest pools of capital have already repriced the future, adjusted hedges, and tightened internal rules that smaller players didn't even know existed. So what I'm about to lay out is not a prediction, and it's not a panic script. It's a pattern. It's the same pattern that shows up in modern currency breaks: the reserve signal, the real-world pricing signal, and the institutional hedging signal. When those three align, the next phase is rarely gentle because confidence moves faster than policy. Welcome to Macro Decode, where we translate messy headlines into clean mechanisms and measurable signals. If you like the calm voice that reads the data before the shouting starts, you'll feel at home here. Consider subscribing so you don't miss the next breakdown, and drop a comment with where you're watching from, because these patterns land differently depending on where you live. Now let's start with the event, because the event is never just one number on a screen. 45 million to the dollar in open market pricing. 2% with food prices reportedly up around 72% year over year. Those figures matter because they show why the exchange rate isn't just a trader's concern. When the cost of essentials rises that quickly, households and businesses change behavior, and that collective behavior becomes the market. In normal markets, currencies move in fractions. A 1% daily move is notable. 2% makes headlines. But when a currency loses credibility, percentages stop being the language. The unit itself becomes the story. People start counting zeros, and each extra zero becomes a vote against the future. That shifts savings decisions, purchasing timing, and even employment choices because stable planning becomes difficult. The most important detail is that this is rarely caused by one trigger. It's usually a chain: external pressure, dwindling reserves, rising budget gaps, restrictions that create parallel markets, and a population that learns through experience that official rates are not real rates. Once a parallel rate becomes the reference, the official rate becomes theater. Businesses price inventory defensively. Importers demand more foreign currency up front. Households shift savings into whatever is most transferable because portability becomes a form of safety. That's the central mystery of every currency event. The mystery is not that a currency can weaken. That happens everywhere. The mystery is how quickly a system can switch from managed to unmanaged in the public imagination. Because the moment the public believes policy cannot hold, it stops cooperating. It stops holding the currency voluntarily. It accelerates spending today instead of saving for tomorrow. And the speed of that shift is what creates the violent part of the move. To understand why this matters beyond one country, you have to zoom out to the hidden pattern. Currency breaks rhyme across decades because the constraints rhyme. In 1997, several Asian economies experienced crisis dynamics that looked impossible until they weren't. Pegs and bands were defended until reserves and credibility could no longer do the job. Result: sharp devaluations, emergency rate moves, and banking restructurings that shaped growth paths for years. In 2001 and 2002, Argentina showed another version of the playbook, a promise to maintain a stable exchange arrangement held until it collided with reality. Capital flight, dwindling confidence, and a banking system that could not meet withdrawals without destroying itself. Result: controls, forced conversions, and a long reset of trust. The deeper break was psychological. Once people learn that rules can change overnight, they priced that risk into every decision for years. In 2018, Turkey offered a more modern market-facing example. A currency can slide for a while under the cover of narrative, but when inflation rises, external. Funding tightens and credibility is questioned, the move accelerates. Result: abrupt repricing, policy scrambling, and a population that starts treating FX rates like weather alerts. Even if a country is not defaulting, the currency can still function like a pressure valve, releasing stress through devaluation and imported inflation. The pattern is mechanical. When an economy depends on external funding or imports priced in foreign currency and its domestic currency weakens, inflation often rises. When inflation rises, policy choices narrow. Raise rates and hurt growth, or keep rates low and fuel the currency decline. Add political constraints, and the decision tree becomes tighter. The longer it takes to address the root, the more the market begins to price not policy, but exhaustion. Now bring that lens to the global layer. The world has a reserve system, and that system is supposed to dampen local storms. But the reserve system is not static. It evolves with trade flows, debt issuance, sanctions risk, and the credibility of institutions. 9%. That is still dominant, but the direction matters. Diversification is not a headline, but it is a pressure gauge. This is where institutional movement comes in. Institutions don't talk about collapse. They talk about diversification, liquidity, and risk management. But behavior can be read. Central banks, for example, have been notable buyers of gold, with widely cited figures suggesting roughly 863 metric tons bought in 2025. Gold does not pay interest. It does not promise growth. It simply refuses to default. And that's why it becomes more attractive when confidence in paper claims wobbles. But institutions are not one monolith. There are central banks, sovereign wealth funds, commercial banks, insurers, pension funds, hedge funds, corporations, and commodities traders. Each one reacts to stress differently. Yet their actions can align because they share the same constraints: capital preservation, liquidity, and solvency. Central banks manage reserves, and reserves are a toolbox. They are used to stabilize markets, pay for imports, service external debt, and signal credibility. When reserves fall, a country's ability to defend its currency falls with them. When reserves are diversified, it reduces reliance on any single settlement network. That doesn't mean a sudden switch. It means incremental hedging. And incremental hedging becomes meaningful when repeated across many balance sheets. Commercial banks care about funding and collateral. They watch deposit flows, interbank rates, and the cost of swapping one currency exposure into another. When the cost of hedging rises, banks tighten lending. Tighter credit turns currency stress into economic stress. Corporations care about supply chains and pricing. If imports are needed, they need access to foreign currency. If access becomes uncertain, they hedge exposures and build buffers. So when tomorrow's payment may not clear at a known price, inventory becomes a form of insurance. Policymakers and regulators become the most consequential players because they can change market structure overnight. Ministries of finance, central banks, banking supervisors, and state-linked importers can shift incentives instantly. A new tax on FX, a restriction on transfers, a new bank capital rule, a change in import approvals, a mandate on which rate is used for which transaction. These choices often aim to buy time, but buying time can also concentrate pressure. Now, let's talk about dislocation, because dislocations are where the story becomes undeniable. A dislocation is when two data streams that should match stop matching. When that happens, it's like a crack in the glass. You can ignore it for a while, but it tells you pressure is building. Dislocation 1 is between official stability, narratives, and informal reality. In a currency stress situation, the official exchange rate might be managed, while the market rate trades elsewhere, often at a premium. The premium is not just a price, it is a measure of trust. The wider it gets, the more the public is telling you the official price is not believable. And once people stop believing a price, they stop behaving as if it is real. Dislocation 2 is between bank money and real money. People assume money in a bank is money, but a bank is a leveraged institution. It holds assets that may be long-term, illiquid, or exposed. When the system is calm, deposits are treated as risk-free. When the system is stressed, depositors learn about capital controls, withdrawal limits, delayed transfers, and the difference between having a number on a screen and having purchasing power in hand. Lebanon's deposit freeze, with estimates around $70 billion in trapped deposits, shows how quickly access can become conditional. Dislocation 3 is between paper claims and physical settlement. In funding markets, the system runs on collateral. It runs on the belief that claims can be settled on time and at known terms. When risk rises, the system demands more collateral, better collateral, and shorter timeframes. That looks like tightening conditions, but at the ground level, it is simply the system asking for proof. When proof becomes expensive, leverage unwinds, and unwinding rarely looks orderly. Dislocation 4 is between domestic inflation and the stories people tell themselves about stability. Inflation is not just a statistic, it is a daily referendum. 2% and food inflation at 72% year over year, that's not a technical inconvenience. That's a social stress test. It changes wage negotiations, pricing behavior, and household savings. It also forces policy into impossible corners because stabilization demands pain, and pain is politically costly. Dislocation 5 is between what markets signal and what politics allows. Markets can demand a rate hike, but politics can resist. Markets can demand spending cuts, but society can revolt. Markets can demand a clean restructuring, but policymakers can prefer a slow, hidden one. This mismatch is where sudden moves are born, not because someone planned a collapse, but because the available options are too narrow for the pressure being applied. A dislocation can persist, but it cannot persist forever. Something has to move to close the gap. The official price adjusts, restrictions tighten, or the market finds a new equilibrium through pain. And when it moves, it tends to move quickly because everyone tries to front-run everyone else. This is the part no one is discussing loudly because it feels technical, but it's where currency events are often decided. In modern finance, a currency is not just a bill in your pocket. It is collateral in a network. It is a settlement unit. It is a promise that other institutions accept. When acceptance becomes conditional, the currency becomes fragile. And when fragility rises, the system builds defenses, higher haircuts, tighter limits, shorter tenors, and more scrutiny. So what does the evidence look like when you put numbers on it? 9% dollar share in Q3 2025. That tells you two things at once. First, the dollar remains central. Second, the world has been inching toward diversification for years, and that drift becomes more meaningful when stress rises because it reduces the assumption that one unit will always be the unquestioned base layer. 45 million per dollar. Those numbers explain behavior. When prices move that quickly, time horizons shrink. People stop saving in local currency. They stop believing wages can catch up. And once that belief is gone, rebuilding it requires either dramatic stabilization or long periods of demonstrated consistency. Evidence point 3 is the institutional hedge, roughly 863 metric tons of central bank gold buying. In 2025, a signal that reserve managers prefer assets that do not rely on another party's promise. Gold isn't a magic solution, but its role as a balance sheet asset becomes more attractive when trust in policy consistency declines and when the world becomes more sensitive to settlement risk. Evidence point 4 is the banking fracture, a deposit hole discussed around $70 billion in Lebanon, with repayment proposals that sound more like settlements than access. It's a reminder that the most painful part of currency events is often not the exchange rate itself. It's the redefinition of what money means inside the system, and the discovery that legal claims can be postponed when the system is under stress. Evidence point 5 is the speed of transitions. In stress periods, bid-ask spreads widen, markets gap, and the same decision made one day later costs materially more. That is why 48 hours matters. It captures how quickly confidence can move when conditions are fragile and when everyone is watching everyone else. Now, if you stitch those together, what does it mean? It is about systems under constraint. And constraints are rising globally. Higher debt loads, more expensive funding, demographic pressures, and political limits on painful reforms. When constraints rise, markets become more sensitive to inconsistency, because inconsistency signals that the system is choosing comfort over repair. Historically, when the pattern tightens, outcomes tend to cluster. One outcome is capital controls. Not dramatic ones at first, but subtle frictions, limits, approvals, delays, taxes on outflows, restrictions on conversion. Another outcome is policy volatility, emergency rate moves, surprise taxes, sudden rule changes, and messaging that swings between reassurance and urgency. A third outcome is repricing events where liquidity disappears and prices gap, not because an asset changed, but because leverage is reduced in a hurry. People often think a reserve currency collapses like a local currency. That's not usually the form. Reserve currencies more often experience slow erosion through purchasing power, punctuated by sharp episodes of volatility when the market tests the system's willingness to defend stability. Stress can show up in inflation, in funding costs, in the cost of hedging, and in political pressure to finance deficits cheaply. The crisis, in that sense, is not a single day. It is a sequence of choices, each one narrowing the room to maneuver. So how is a currency break executed in practice? Mechanically, it's rarely a villain and a button. It's an interplay of incentives. Imagine a dam. The water behind it is pressure, debts, import costs, budget gaps, and expectations. The dam is policy, rates, controls, reserves, and credibility. When water rises, policy can raise the dam with tighter rules and higher rates. But raising the dam has costs. It can crack the economy. It can break borrowers. It can create unemployment. So policymakers often compromise, and compromises can leak credibility. Markets don't wait for hope. They test the dam. They look at reserve levels, financing needs, and political constraints. If they sense the dam cannot be raised enough, they move. That movement can look like speculation, but it is often arithmetic. How long can reserves support? The policy, at what cost, and with what credibility? Then the chain reaction begins. A weaker currency raises the local cost of imported goods. That feeds inflation. Higher inflation drives demand for hard assets and foreign currency. That increases pressure on the exchange rate. To slow the loop, authorities may tighten access to FX, which creates a parallel market. The parallel market price becomes a new reference. Businesses start pricing based on it. Workers demand wages based on it. The official price becomes relevant. That is how a currency crisis turns into an economic crisis. Inside the financial system, the mechanism often runs through collateral. If a borrower posts collateral and the lender fears volatility, the lender demands more. That is a margin call in plain language. If many lenders demand more at once, borrowers sell whatever they can sell, not what they want to sell. Forced selling pushes prices down, which triggers more margin calls. The cycle feeds on itself until either liquidity returns or leverage is reduced enough to stop the cascade. This is why institutional hedging matters. It's not just buying an asset. It's changing assumptions about what is acceptable collateral, what tenor is safe, and what counterparty risk is tolerable. When those assumptions tighten, the system becomes less forgiving. And a less forgiving system is where small shocks become large events. So what does forward analysis look like without pretending to know the future? It looks like watching the same indicators that historically changed first. If reserve diversification continues and the dollar share keeps drifting lower over time, it suggests gradual adjustment in the global reserve structure. If real-world inflation and parallel market premiums widen in stressed countries, it suggests more localized currency fractures and more controls. If institutional hedging accelerates, visible through tighter collateral standards and rising hedging costs, it suggests more defensive positioning. There are usually three scenarios. The conservative scenario is a slow grind, modest diversification, manageable volatility, and periodic stress events contained with policy tools. The moderate scenario is more episodic, repeated shocks, sharper repricing, and more frequent use of emergency measures. The aggressive scenario is a confidence event, a sudden re-rating of risk that forces rapid policy shifts, and a scramble for the most trusted collateral. Historically, when funding tightens and credibility is questioned, volatility tends to spill over borders. What to watch is specific. Watch reserve signals, not opinions. Watch inflation prints and the cost of essentials, because that's where confidence lives. Watch policy consistency, because markets punish uncertainty more than they punish bad news. Watch the premium between official and real pricing where it exists, because that premium is a direct measure of trust. And watch the plumbing. Collateral terms, liquidity conditions, and sudden rule changes in funding markets. Those are the early tremors. Now we reach the divide, because every cycle creates one. The divide isn't between smart and not smart. It's between those who track mechanisms and those who track narratives. Narratives are comforting until they aren't. Mechanisms are boring until they matter. The people who follow the three signals early tend to understand why the move happened, even if they didn't know the exact day. The people who follow headlines tend to feel blindsided even when the indicators were flashing. And the most consistent rule is this: institutions move first, households move last. Not because of evil intent, but because of incentives and access. Institutions see collateral terms, they see funding rates, they see settlement friction, they see reserve decisions and cross-border flows. Households see the price at the store and the headline after the fact. That information gap becomes a wealth gap, and it widens during stress. So if the title of this video is Currency Collapse Warning, three signals flashing red, those three signals are simple to name, even if they are complex to live through. Reserve behavior is shifting, real-world pricing in stressed places is breaking, institutional hedging is persistent. None of that guarantees a single dramatic outcome. But historically, when those signals align, the next phase is defined by tighter choices, faster moves, and bigger consequences for anyone who assumed stability was automatic. That is the quiet warning today. This is macro decode, where we connect what matters before it becomes a headline. If this connected dots you hadn't put together yet, you know what to do. The question isn't whether volatility returns. The question is whether the signals are recognized before the screen turns from numbers into zeros.